Welcome to the Tax Awareness Show. My name is Shilibo Mutiva. I'm your host, and today we're talking about succession planning for those family businesses, of course, and for entrepreneurs. I'm joined today by Nico Banda. Nico, welcome.
Thank you so much for having me, Shilly boy.
How you doing?
Happy to be here. Good. Looking forward to the show.
Yeah, let's have fun. Guys, for entrepreneurs, it's always something that is at the back of their mind where they're talking about really who's going to take over from here when I retire, or for that matter, if my time is up on this planet Earth, right? Am I correct?
100%. Yeah.
Tell me something. Maybe let's just get into it. Take me through one of your maybe let's start with a difficult one. What has been your most difficult succession planning case you've dealt with?
Look, I think, probably the one I'm dealing with right now, it wasn't necessarily a succession planning matter, but I think it's an interesting one to sort of speak about and share, because I think for a lot of entrepreneurs, they spend so much time building these businesses and building value in these businesses, and 20 odd years pass, 30, whatever the case might be, and then you might get to a realization that this business might not be worth anything if I'm not around. I am the face of the business. I'm the business. I get the work done, and I go out there. And I thought this case is particularly interesting because it was more around the initial consult was more around how can we extract value from this business as a partnership. So you've got these two partners, they're architects, they do developments and, typical architecture work. And they've had this business for plus 20 years. You've owned this business together 50-50. And this was more around buy and sells. Well, they were trying to extract value through a buy and sell. And
maybe just before, sorry, let me interrupt you there. Also, what is the buy and sell for someone who doesn't actually understand?
Thank you. You get used to saying things there, but a buy and sell, basically, you get two shareholders, and it basically provides the one shareholder with enough capital to buy the shares of the other partner when they die. So you technically just take out life insurance on your other partner. When your partner dies, you then have the capital to buy the business from his estate. Okay. So that's how they were looking to extract the value out of the business. But then he said to me, one of them, he said, look, the sobering reality is we've built this business for 27 years, and it might actually be worth nothing. If I'm around, if I'm not around, my partner can take this business and continue the business. If I'm not around, if both of us are not around, then it actually might not continue. It might just be a case of winding the business up. So the one that actually stands to benefit is the first dying, because he'll at least get paid out a sum of money. His family will get paid out a sum of money, and they'll have that value extracted. But I think that was particularly interesting, and they had this idea, and when we spoke about it with them, the main thing was there's no one else that can go to their partners and source the deals, and I thought in my mind, I'm like, that's just poor succession planning for 27 years to have a business.
But in your view, what went wrong?
I think like most entrepreneurs, the main focus when you start a business is to make money, and you're so focused on this, but there's also that, keep my cards close to my chest. You don't let your employees in. You don't build someone within the business to take over the business. Even if it's from a family, if you've got family members in there, the idea is you might actually allow your family members to, attend the meetings with these partners, these clients, the people where the business comes from. Whereas if you've got an employee, you sort of, in the back of your mind, I think the thought as an entrepreneur is, well, if they leave, then they have access to all these people and all these contacts. But in the end, what it does is you put yourselves in the position where these people are, where on the first dying, there's an extraction of value for that business, when the buy and sell pays out. On the second dying, unless someone's willing to buy the business, and they are sure no one's willing to buy the business because they are the business, then there's no value for him. When he dies, it's just In fact, it's more work for someone to wind up.
Maybe let's say these guys, they've got an opportunity to salvage and restructure their succession planning. What would you tell them to do?
Look, I mean, they've had the business for 27 years. They've got employees that have been there for a while. And I think the reality is they need to then accept to lose some of that equity and try and build one or two people in the business who actually they've seen the potential in. If you've got someone who's been managing, some of the big projects, they've been around for a certain number of years, you need to incentivize them, because as long as they're getting paid a salary, as soon as someone's able to pay another salary, you might lose that talent. Whereas if you've then provided the opportunity for them to actually grow in the business in a way that leads to some form of ownership, and you don't have to give them shares now. You can vest these shares over time. They can work towards earning, and you can stagger it, for every couple of things and, the first few shares. And it's not just a small business thing. Even the big businesses do that. They create these employee share schemes because that's where the real value is for an employee. If you're just earning a salary, someone's always there to be able to offer a bigger salary.
So basically, take care of your employees, incentivize your key employees that you're targeting so that you can retain the best talent, so that then it helps you with succession planning. You remind me, actually, in our last episode, we spoke about entrepreneurs actually thinking that their business are actually their retirement package. But actually, what you are saying is that it actually may not be your retirement package if you're actually not planning succession planning correctly, because there's a correlation here between proper succession planning and actually the value preservation of the business. So if you don't get it right, the succession plan, you can actually end up working against the value of your business, which is quite interesting aspects of this. But maybe take me through the emotions, because from what I'm hearing here, there's a lot of emotions involved in this thing. How do you converse with these guys, from emotional perspective, so that they buy into your succession planning?
Look, I think it's always whether you're doing succession planning for business or you're doing estate planning, for the person's actual personal estate, I think it's always going to be an emotional decision, an emotional discussion, because it actually presents the idea of you not being around anymore. It speaks to your mortality, and people are very afraid to, deal with the fact that they're actually not immortal. At some point, something can happen in you. And it's not just death, it could be incapacity in one way or another, But I think the reality is, for like the example I just gave, being able to actually let promising employees in a way that they can see themselves being part of the business on not just an employment level, but on a partnership level. I think that's the one thing. But then from a family business perspective, and I think, we see this a lot where you get this person, they've been so successful, they've built this business, and the daughters are most of the times the ones that are actively involved in the business throughout, and you get the son who's got his idea of what he wants to do, where he wants to be, right? But the father's stuck on this idea that my son is going to take over the business. You have to be able to accept that this business is only worth something if it can continue or if it can be bought.
Maybe let's, again, on emotion side of things, exactly on what you just mentioned now, how do you have a conversation with someone who still has these old-fashioned values about, seeing sons as people that must succeed them in their respective, despite the daughter actually putting some weight and being competent, actually to take competency not being an issue? How do you have a conversation with someone like that?
I think the idea is to get them to understand that what exactly do you want to achieve? Do you want this business to be a legacy family business? Do you want this business to continue after you? Because if you want to act in the best interest of the business, if you want this to be a business that's able to provide for your family, create some family legacy wealth, then you have to make decisions that aren't based on emotion. You have to make decisions that are based on the actual success of the business. You know, there's no succession without success. There's got to be some form of success. And the reality is, if someone's not interested in the business, they're not going to give it the same type of care that the business needs, right? And I can guarantee you that when you sideline your daughter and give your son the business that he has no interest in, it's only probably a matter of time before any business partners see that and probably decide, well, I'm not going to wait until this thing fails, or they run it into the ground. But you also, she's not going to stick around to help, you know, when she's been sidelined. She'll just say, well, okay, fine, then I'll go do my own thing. You know, so competency, you know, what are you trying to achieve? And you put that picture in their heads, and sometimes you might not win. But then at some point they realize, well, this value in the business then just ends with me, you know, and you have to be comfortable with that. So I think the big thing is, what do you want to achieve as a business owner? You know, so from an emotional perspective, that is key.
You are young in relation to the guys that you are advising that are already thinking about succession planning. Not to say that you shouldn't think about succession planning even at the early young age, but in most cases, the guys that tend to start worrying about succession planning are fairly qualified to be your parents. How do you have a conversation with these elders as a young Nico around the issue that has to do with emotions? Because succession planning is emotional side of things. How do you deal with it? How do you cope? How do you even approach these guys?
Look, I mean, I'm younger than them, and I'm probably not even close to being as successful as them. So there's that side to it. You know, I can't even back it up with, well, but look, I mean, I think like any career you take, you get to a point. I mean, when you're starting off, you're very insecure, and you've got that, you know, that little bit of I don't want to say anxiety, or you doubt yourself a little bit more, but I think you need to be sure in the value you can add, you know, from whatever career it is that you're doing. You get to a point where you need to be sure of the value add you provide, you know, and when you start being more confident in that, you speak knowing of the value you add, and you get clients that are difficult at the start, you know, but when they see the value add, they start to give you a little bit more of the respect, and, you know, very much just take your advice. But I also want to say, you get some really good people that just trust you as the expert to give them good advice. So, you know, I've got really good, successful clients that have never questioned me about age, and I appreciate that, because you walk into those meetings and you're dealing with people with lots of money and lots of success, but I think you've got to walk in there knowing the value you add, and I think that's the most important thing. And also, your client's not going to say, when you give them bad advice or don't say something because you're shy, when it goes wrong down the line, they're not going to say, well, you were young, you know. So if you've got something that you feel is the right way, then you express it, you know. Obviously, the respect is always a factor. It's got to be there. But I think respect is something that has to be there in any circumstance, in any case, whether you're dealing with someone younger than you, the same age. I think, you know, how you approach it is important. But you just got to be sure, you know, you add value. And that's the most important thing. And you're adding value to their lives, and you must charge for it.
You're adding value to their lives, but some clients actually extract value out of their lives. What has been some of the funny, weird transaction you've seen during reviewing the files and structures when you're about to do succession planning?
I think people do some really interesting things. And I blame those LinkedIn posts with the picture. This is how wealthy people don't pay tax. Put your assets in this, and, you know, those, they don't tell you anything else, those pictures. They just tell you, if you put your assets in this, you can be like, you know, Bill Gates and not pay tax. And they do these things, and you see a lot of things in our world. You see people move companies into trusts and then just move along like, you know, it's a normal thing. You see them move a company into a trust and then still receive the dividends in their name. I thought, well, if you're not the shareholder,
not even worried about the tax consequences there.
Exactly. I mean, the fact that you move the stuff just willy-nilly, I mean, and the problem is, because it's just one of those things where you just change the share register and change the share certificates. They think it's done. But then on top of that, they just receive the dividends in their personal bank accounts for years.
Sure.
And then they come to you later in the years and they say, yeah, I've been thinking about this and I just want to do a will. Then you start asking questions. Okay, how did this? And then it's like this. So those are
they flow with it. Quite some exciting things that you're exposed to, though a bit emotional. Speaking of exciting stuff that you're exposed to, what has been your most exciting actually case that you've dealt with?
Yeah, I mean, I think, you get some exciting stuff. You get those really poorly done transactions, and it's exciting it's not great for the clients, but as a professional, it's exciting to be able to pick up on certain things and provide value to the client by saying, well, this thing is a bit of a problem, and people do a lot of things when they're trying to reduce how much tax they pay. But I think more for me, from a succession point, and that touches on to the example I was saying, one client, really successful, built this business. He has a business partner. Last valuation was about 100 mil. So it's a very established, good business. He's got a business partner. He owns 50% of the business.
Correct.
His son wants to be a professional golfer. His daughter's been involved in the business. She practically runs the business. She's head of operations in the business. She runs the business. She knows the business like the back of the hand. He says, my son is going to take over my 50%. And you're sort of trying to say, number one, how does your business partner feel about this? Because they forget they have partners, entrepreneurs. How does your son feel about it? How does your daughter feel about it? And you can't force your son. I've given him a couple of years. If he doesn't make it professional, then he must come work in the family business. In fact, that won't incentive. If he doesn't make it as a professional golfer, I doubt it will incentivize him to do well in the business. Then he's better off doing something else he might actually want to do. So those are some exciting things. But maybe from going back to poor structures, you get clients, they moved this company, they started working, they moved this company into the trust. It was making about $1 million, in revenue, probably 15 years ago. Someone said move it into a trust. So they each moved their separate shares into the trusts. They have shareholder loans in their names, but in their personal names. But the trusts are now the shareholders. So I said, well, when you moved the businesses, was there a loan account? Was it a donation? Did you pay donations tax? And all these things are just like, oh, what is that? And I said, who gave you the advice? Oh, no, we went to some person and then they said, we must move this and then we won't have to pay state duty. And we say, well, that's the problem in our world. You pay to set the structure up, but you don't want to pay ongoing advice fees. And then now you're 14 years down the line. It's like, well, got a lot to do here.
And I mean, to restructure that or to regularize those transactions can quite come very costly. I mean, if, for example, you've got these transactions that are sitting in the trust, or for that matter, you've got loan that you in a company and you've got loans that are going via the trust coming from beneficiaries, there are quite onerous tax implications on their own there that a client will need to consider. And if you, like you said, you're going to cut corners and not pay for value, because like you said earlier, you demonstrate value, but clients also needs to pay for value. And if you come and you want tax advisory for loans that goes into the trust as beneficiaries, compliance around that, you gotta have to pay someone to definitely advise. Maybe speaking of trust, I mean, trusts are something that, if used well, can actually also help with succession planning. Am I correct? What has been your experience with utilizing trust for succession planning?
Yeah, I mean, I think trusts are useful, right? And, what anyone else might say around them is, everyone's got a different view, but they're useful if you want to use them for the right things. From a succession perspective, when you've got assets in the trust, let's focus on the business succession side of things.
Yeah.
And maybe I'll put into, I'll bring my client with old values into this case. His biggest worry about the daughter not being the succession plan is that she might get married to some guy who just, takes over everything. And then a trust would be a useful way to actually ring fence some of those anxieties. If you're saying, I understand the competency, my worry is more of a personal thing around someone coming in and doing that, you can use the trust, because then the trustees, your daughter can still run the business. She can still continue. She can be the director, the CEO, whatever the case is. She can manage the business. But the business is owned by the trust. And the trustees effectively are responsible for that business to a large extent. So there's none of that where it can be taken away by, someone that comes in and destroys the family structure. So you can use those things, and it's cheaper to pass on because the trust doesn't die, until you terminate it. So every time someone dies, there's no transfer of shares and, capital gains triggers, that kind of thing. So those are useful, those are useful ways to use a trust in succession planning. You house the actual asset being the shares in the trust. The trustees manage that. You get a good professional trustee. I always emphasize, get a good professional trustee. Cheap advice is expensive.
Correct. I agree with you. But I mean, speaking of professional trustees that are important if you want to preserve your wealth, how would you go about actually selecting if someone will make a good trustee? What should you be considering?
I always say, I think it's good to know what you don't know. And any advisor, whether they're acting as a trustee, financial advisor, whatever the case might be, legal advisor, an advisor who can tell you that they don't do something because they don't know it is important. Not an advisor or a trustee that tells you they can do everything. They'll do the tax returns, they'll do the loan accounts, they'll do the accounting, they'll do everything, and just because they want to ring fence all the remuneration that would outside God. And I think that's important. So and they play an active role, and I think that's where a lot of things go wrong. People said, you set up the structure, you've never had a trustee meeting. I send emails all the time. I'm reminding my clients about certain things. When something's changing, we send them a little update. This has changed. We need to, discuss. Let's have a 15-minute discussion. At the start of every year, let's see what we want to achieve for the rest of the year. Those are important things to do. So if your trustee is not active, I think that's the starting point. If they're not active, if you haven't spoken to your trustee in over a year, something's wrong.
Something is wrong.
Yes, there's something's wrong, and a trustee that won't tell you what they don't know and just says yes to everything.
Maybe a simple question for someone who's already contemplating, say, listen, I've heard Nico, I was worried about my daughter being taken over, and now I'm happy my daughter can actually take over since that anxiety of some gentleman coming and taking over my business it can actually be protected by me having a trust, right? And the question could be, as a founder, or founder of the trust, can I actually be a trustee?
You can, you can be a trustee. You've always got to have an independent trustee, because the last thing you want is for your trust to be seen as an extension of yourself, an alter ego, as they call it. That's the last thing. So if you're the founder, you make all the decisions, you're the sole trustee, they're just going to look at that thing and just say, this isn't X's trust. This is just X acting in his personal capacity, trying to avoid certain taxes and that. So you can be a trustee, you can be a trustee. Get a good independent trustee as well, always.
You spoke of extension of yourself, alter ego.
Yeah.
What are the risks if my trust is considered to be an extension of myself or an alter ego? What is that?
So essentially, they'll usually just call it a sham trust. So alter ego is like the less because sham sounds very criminal, but and, you know, they just view the trust as, so a trust basically creates a barrier between yourself and your assets.
Correct.
And as soon as that barrier is seen to be as non-existent, because you actually just do everything yourself, you make the decisions, they take the barrier away and they start to put everything directly back at you. So you no longer get the separate legal person protection that you would get, that separation between the two. So essentially that Chinese wall you build up with the trust just gets, you know, they just jump over it because you have not in any way created a separation.
But what are the practical examples that you can give one not to do in order not to create that extension of myself? What have you seen in practice that
control?
Yeah.
So control, the amount of control you as the founder has over the trust. You know, some people say, my trustees can make a decision, but only if it is approved by the founder. I mean, then what's the point of the trustees if they first need the founder to approve before a decision can be made? You know, getting an independent trustee. And when I say independent trustee, I don't mean your best friend because they're not your family member. Get an independent trustee, someone that's a professional that understands how trusts work, the implications, you know, from a tax perspective, a legal perspective. Get an independent trustee, and you can't exercise all the control. You can't exercise all the decision-making powers. You know, it's important.
But you spoke of sort of a trust creating that firewall or Chinese wall between yourself and those assets. To me, it feels like there's a sense of letting go.
Yes.
And as entrepreneurs, we tend to struggle with control. You know, I've built this business. Yes, I'm considering succession planning. Yes, my daughter is going to take over. Yes, or my boy is going to take over. But, you know, they're letting go. They're letting go now. The decisions of the business or the decisions of the trust and the investments, I need to consult Nico. I need to consult other trustees in this thing. So already there's an emotional side of this. How do you convince clients to let go and respect the very firewall that can actually safeguard their wealth? How do you convince these guys to actually respect that control, to let go?
I think the most important thing is your client has to feel like you're acting in their best interest. As soon as they don't feel that way, they will never relinquish control. You know, but the being able to let go goes back to my first scenario of my architects. Because they've failed to let go of some control, not even all of it, you know, by introducing someone in the business into various things. They've then actually lost the succession planning capacity of their business, you know. But from a trustee perspective, you as the entrepreneur will likely still be the director of the business. So you will run the day-to-day operations of the business. You will make the decisions. What we're saying is the shares are held in trust. We make decisions as trustees that affect the beneficiaries, but are in the best interests of the client. So that will be the beneficiaries, the trust itself, and you know, the founder in most cases, because he's our client. So we will always, but you as the entrepreneur still make direct control, still have direct control in terms of the business because you're the director, right? Where shareholder decisions need to be made is when we would pop in as trustees to make, you know, to be part of the shareholder meeting and do shareholder resolutions and the likes. But the effective control or day-to-day management of the business is largely in your hands as the director. Yeah.
Are the trusts really still valuable when it comes to, from tax perspective though?
Yeah.
I know that as a tax advisor, you shouldn't be entering into structures or transactions primarily for tax purposes. But as a secondary, maybe objective or secondary purposes, are trusts still tax beneficial?
Yeah. So I mean, I always say your intention is important, and you've said yourself, you know, you're the main reason you do something can't just be to avoid taxes.
Correct.
But I would say the line between avoidance and evasion is very thin. If you aim for tax efficiency, trust is still worth it because there are various, you know, the flow through principle is still very valuable. right? The fact that you're able to flow through income and capital gains to your beneficiaries is still very valuable. Yes, they are anti-avoidance rules, but the reasons they exist is because people keep doing stuff to try and actually avoid paying taxes. So you must be comfortable that you will pay taxes. You just try and pay it efficiently. But they're still valuable. There's still some value in holding a trust, depending on what you are intending. And it depends on the client's circumstances. Sometimes you're using the trust because you've got a special need to protect.
You spoke of flow through. I mean, for someone who doesn't know the flow through, what do you mean by flow through?
Yeah, so essentially, and that's why I didn't want to use the word conduit, but it's the principle that just allows you, in tax purposes, to actually flow through the income and capital gains to the beneficiary. So you're instead of the trust paying 45% tax, and retaining the let's say the trust owns a property, earns rental income on the property. If the trust returns that income, it will pay 45% income tax. If you've got beneficiaries there that are in the lower income tax bracket, you can just distribute that income through to them, and they will pay it at their tax rate. So that's you. So you're basically flowing through the potential tax liability. Obviously, there are anti-avoidance mechanisms still in place that need to be considered always, but it is effective. Used effectively with good advice, worth it.
Okay, Nico, just take me through. I mean, you are a professional fiduciary specialist. Maybe in closing, what made you to go into the fiduciary sector? And what would you tell that young child who's at university and maybe thinking that, listen, I'm going to follow the route and go into fiduciary sector?
Look, I mean, I think, when you go, when you study law and you go to law school, they teach you to be an attorney or an advocate, and I guess having not taken the attorney or advocate route, I tried a different option. Started off in labor law, then I realized working for a private entity as a labor lawyer, doing labor for them is just not ideal for me. And then I, went into the space where, initially it was as a fiduciary assistant. So, and mostly because I like succession law in varsity. Then I realized it's actually a very broad role. It's very broad, it's very wide. And they're different, there's the tax side to it, there's the structuring side to it. It's interesting, it's interesting. It takes a bit of time because there's so much learning that actually goes into the early stages. And you only get that kind of you only get that kind of knowledge and skill from experience, from sitting in when people are doing structures, hearing these things. But I think it's a growing field. I think it's going to be a very important field, especially as the number of people garnering wealth in South Africa increases.
Correct.
I think the work and the value we're able to add will be just as important as the same value that the financial planners and the financial advisors are giving, the tax advisors are giving. And I think most importantly is you don't have to be good at tax to be a fiduciary specialist. You don't have to be good at investments to be a fiduciary specialist. I think there's an area in the fiduciary services for everyone. There's some people who just do trust admin. There's some people who just do estates. There's some people who just do estate planning. And then you get some people who are a bit more well-rounded. How you go about it, you can always specialize. More. So I think it's a growing field. I think there are lots of opportunities there if it's something you want to consider, but it's something you've got to have an interest in. I think that's the most important thing. It's like tax. If you don't have an interest in tax, it's probably not the one for you.
Maybe the part in short, speaking to entrepreneurs who might be listening, or high net worth individuals who might be listening or watching, what would your message be to them around succession planning?
I think, the right time to start is now, always. If you succession planning, where your business is, you got to have that in mind. You need to have an idea of your business after you, and that will determine the decisions you make, while you're building the business. I think good advice is important. So, and it's never too late. And I think that's the thing is, I say when clients come and you tell them everything you've picked out there, the biggest thing is the anxiety. And I always say it's never too late to restructure. It's never too late to correct. But the reality is the sooner the better.
Thank you so much, Nico. That was quite mouthful. I enjoyed myself. I've learned so much. And I hope that you also learned so much today, talking everything to do with succession and tax planning for you as entrepreneur, for you as high net worth individuals. My name is Shilbo Mutiba. I'm your host of the Tax Awareness Show. Thank you for watching to now. Until next time.